Um, a few days ago, I made this video about why I think it might be a good idea to use stock data to study some of the deep learning techniques, especially the reinforcement learning technique. Um, in that video, I was making this kind of a comparison between the Go game and the stock market, right? And I was saying there are at least two similarities between them. One is the delayed reward, which is common to both things, and the other one that's common to both things is the huge, astronomically large sample spaces, right? And I was trying to make a point that artificial intelligence like Alphago, which is trained using reinforcement learning techniques, might be better than human beings in handling those two things, right? Two aspects of investing. So in this video, I would like to provide some more perspectives about those arguments and to elaborate upon those two similarities, right? Um, what about the what about the delayed reward, right? In fact, investing is all about delayed reward. You put away some money today um, in the hope that you can get a much bigger reward in the future, right? So this is some kind of a formula that most of us are familiar with. The future value of some kind of investment equals to the present value, right? Times 1 plus RR is the interest rate to the nth power, right? N is the number of years that you are actually investing. Uh, so if you are investing in the stock market like SPY, which grows at 8 to 10% per year, then it's 1 plus 0.08, right? And then to the nth power, n is the number of years that you are investing. So if you are investing for like tens of years, then this number compounded by this many times, it's going to be a very big number, and it could get a very large reward if the estimate of the rate is kind of correct, right? And this is the formula that we're actually familiar with, right? So you use the current value to estimate the future value, right? Considering the interest rate. But a different way of looking at exactly the same question is to ask if I want a specific amount of future reward, how much money I should invest today, right? And if you ask the question this way, and then you get something that's called a discounted cash flow model, right? It's kind of a discounted cash flow formula. So the present value that you should invest today equals to what? Equals to the cash flow that you want to get, right? But discounted by 1 plus the interest rate. This is the power that should be equal to the number of years that you want to sort of invest, right? And this kind of discounted cash flow model has been used by economics, used in economics, right? Finance, right? So if you have those backgrounds, this kind of formula is not sort of too foreign to you, right? And in the stock market, this kind of discounted cash flow model can be used to estimate, for example, the valuation of a specific company, right? So you need to look at the cash flow generated by the company, right, for many years into the future, and then discount those cash flows according to this kind of a factor, and then add them together, and then that's going to give you the valuation of the company, right? And the stock price is determined by the can be computed by the valuation from the valuation of the company, right? So in the past few days or past few weeks, the stock price of those tech companies has been dropping, right? One of the reasons that people seems to believe in is that the interest rate, in particular the 10-year bond yield, is rising very quickly, right? So if interest rate R is rising very quickly and the cash flow for those tech companies are relatively small or constant, then because this factor is on the denominator, right? So if the R increases, then you are dividing a bigger number, right? So that must reduce the current value of the current valuation of the company, right? So stock price is supposed to drop, but that's what people seem to believe, right? But it's not true. It's not true. In practice, you never do that kind of calculation using instantaneous rate, right? If you use instantaneous rate, like 1.5% or something, the valuations of those tech companies is not overvalued. It's it's hugely undervalued, right? The interest rate you have to use is some kind of averaged interest rate over many years, right? So if you use a more realistic averaged interest rate through many years or sometimes decades, 4 or 5% is probably more realistic, right? And in that case, those tech companies are not really overvalued. Um, it's um, it's um, it's uh, it's there's no bubble. At least there's no bubble in those tech stocks. At least according to this discounted cash flow model, right? Um, um, and so this argument about interest rate rising causes the huge drop in stock prices of those tech companies. It's not really true actually. Right? It's not really true. Um, Most of those selling was actually driven by emotions, and that's one of the things that I will talk about. Why I think artificial intelligence is actually better in dealing with this kind of future rewards, right, or delayed rewards, right? Um, so so that's the discounted cash flow model. That's the discounted cash flow model, right? But now let's look at another equation. Another equation that's used in the Q learning, which is one of those reinforcement learning techniques used for training Alphago, right? Um, which is this equation. We haven't actually come to this equation yet, right? But it's a very important equation. It's called the Bellman equation, right? And the reason that we haven't actually talked about this equation is because we don't have enough preparations to understand this equation at the current stage yet. But if you look at the format of this equation, Q represents the value of a certain action A at the state S, right? The value of a certain action at the current state S equals to R is the direct reward. In this particular formula, R is not interest rate. R is the direct reward that you can see and feel immediately, right? Plus some factor gamma, and this gamma is called actually discount factor, right? Times this very complicated formula involving taking the maximum across all the different actions, right? And then let's just forget about this max A, this thing for now, right? But look at what's actually inside of here. That's value Q, right? For state S prime, if you take an action A prime. What exactly is S prime and A prime, right? So if S and A is the state and action that you are sort of evaluating at time step 0, then S prime and A prime is the state and the action that you take at time step 1, right? So basically this Bellman equation gives you this kind of relation between the value of a certain action at the current state with the value of the action that you take at the next step, the next time step, or next state S prime, right? So do you see the similarity between this equation and the discounted cash flow model, right? If you replace gamma with 1 over 1 plus R, right? Then you get gamma times CF1 plus gamma squared times CF2, right? And then goes on to gamma to the nth power CFn, right? Like that kind of thing. But where's gamma 2? Where's gamma to the second power? Where's gamma to the third power, right? Don't forget, this equation is between two neighboring time steps, right? So if this equation holds for time step 0, then it must hold for time step 1. So you have this kind of relation between time step 1 and time step 2, right? So what is actually QS prime and A prime? That's the value of the action A prime that you take at time step 1. It has to equal to R plus gamma times this max A prime stuff and a Q. Say the state at time step 2 is S double prime, and the action you took, it was A double prime. Then it's going to be Q S double prime A double prime, right? And if you stick that representation into here and carry out the calculations, then you're going to get R plus gamma times R, right? Plus gamma times gamma, that's gamma square, Q S double prime A double prime. Now you got gamma square, right? Right. And what I was saying that this calculation is recursive, and then you can actually expand this calculation to as many time steps that you want. So eventually you're going to recover exactly this discounted cash flow model that you use for evaluating stocks, right? all you have to do is to replace gamma, this discount factor used in this Bellman's equation, with 1 over the interest rate, 1 over 1 plus the interest rate. Right? Isn't that right? Isn't that right? So this kind of a delayed reward, that's kind of discussed in the context of economics or finance using this discounted cash flow model, is automatically accounted for by the Bellman equation used in reinforcement learning, in particular this Q-learning technique, right, for training artificial intelligence like Alphago, right? What about Alphago? Let's look at Alphago. Let's look at how well Alphago handles this kind of delayed reward much better than human beings, right? This is the match between Alphago and Lisato, right? This is actually the second game in this 5-game match, right? And one of those best moves made by Alphago was actually move 37. Move 37 on this second game of this 5-game match, right? That's this black stone here. So if you look at the board, it's still quite early stage of the game, right? There are actually only 18 black stones on the whiteboard, and this is the 19th black stone, right? So Alphago actually placed the 19th black stone at this particular position, right? If you have played Go before, it's going to be very, very puzzling for you, right? Why Alphago choose to actually place the stone here, right? Because it's very far away from this particular edge, right? And it looks like the black is pretty much conceding all those big spaces underneath here to the white stone, right? To Listo, right? In fact, it's not just you, but all those professional players were all puzzled by this particular move, this move 37, right? Move 37. Nobody was able to actually tell what's actually the purpose of Alphago by placing the stone over here, right? Because if you want to sort of attack those weak white stones over here, they are better positions, right? You might want to move it closer to those white stones, and if you want to sort of build some territories with those black stones, you might want to move those black stones downward, right? But placing this black stone over here, it's really puzzling, right? Because all the professional players, all the professional human players, could not see the direct benefit of this particular move, right? This move 37, and this is how long? This is about 45 minutes into the game, right? So this is still at a very early stage. This is, and in fact, the exact purpose of this black stone was not really obvious until like more than 100 moves later, right? So after Alphago made the 37th move, the fight was actually over this corner. For the next like a half an hour or something, it was all fighting over this particular corner, and Listo was actually winning over this particular fight, right? It's actually at least not conceding any ground to Alphago in this corner fight, right? And the Blackstone or Alphago was actually not really playing a very strong hand during this particular fight, right? And the 37th move was this particular stone. This is how many hours? It's about more than 1 hour into the game now, right? Into the game, and the shape of this right lower left corner has been kind of developed quite well. Actually, Listo was actually doing quite well over this corner, right? But the purpose of this particular 37th move becomes more and more clear. Some people start to guess. Some of the professional human players start to guess is that the purpose of this move was to actually make connections with the one with the black stone over here, with the black stones over here, right? But at least at that time, it was just a guess. It was just pretty much just a kind of a speculation, right? Because the distance is very, very far, and everyone was focused on this particular fight in the corner to take up grounds, to take up a territory, over this particular corner, right? But look at the shape of the board after more than 100 moves, right? So at this particular stage, um, it's quite obvious now. It's actually quite obvious now. That's the 37th move, right? And it has already made the connection with the black stones over this corner. And during that process of making those connections, the black stone Alphago has actually taken control of those big spaces down here, right? That's the 37th move, right? And now it's 4 black stones over here. And these 4 black stones not only actually allowed the Alphago to actually take control of the big territory underneath here, it also actually captured all the white stones over here, right? And by the time you reach about 300 moves, it's kind of obvious that Alphago has won, right? What's actually surprising was that maybe you think that developing from this kind of board to this kind of board has somehow it's purely just out of chance, right? It's just out of chance. It's not really some kind of a planned behavior. It involves lots of randomness. But maybe it's true, but I don't really believe that because at the 37th move, when everyone was puzzled about why Alphago was actually making that particular move over here, the output from the Alphago algorithm was showing that it is very confident that it has a 90% of chance of winning the entire game, right? So in fact, after the 37th move, the output of the Alphago algorithm, the confidence of the Alphago algorithm never dropped below 85%, right? So by the 37th move, Alphago is already very confident that it's gonna win the game. It's gonna win the game in the end, right? So if you are saying that starting from this particular shape of the board to this shape of the board is purely just by chance, that's not really a convincing argument. Somehow Alphago, through this kind of a really sophisticated Q-learning or deep learning technique, has actually anticipated the outcome even after hundreds of moves that's beyond the comprehension of professional human players, right? So this reinforcement learning technique is actually quite a powerful technique that actually has this kind of deterministic power to foresee something that human cannot capture, right? And this kind of a delayed reward is particularly important in the Go game than in any other kind of a board game. For example, in chess games, this delayed reward or this kind of a consequence of a particular move shows up after a few moves, a few exchanges between the players, right? At least like 10 exchanges or tens of exchanges, right? It's never lasting until like hundreds of moves later, right? But why I think artificial intelligence is actually better in handling this kind of a delayed reward than human beings, right? There are 2 things that's preventing human beings from obtaining this kind of delayed reward. One is, of course, the memory, right? People can only remember that much things, right? People forget, right? If you want to sort of be able to actually anticipate something hundreds of steps later, you have to be able to at least have the memory to memorize all the hundreds of steps and then make inferences on it. That's extremely complicated, and it takes lots of computing power. That's the memory. That's the sort of the one of the reasons, right? Why artificial intelligence could be better, because machines has very good memories. It's not going to forget about things, right? It's not going to forget about things. It's if you are storing it somewhere, then it's somewhere. It's not going to lose it, right? But a second thing that's I think it's even more important um, in the stock market is about emotions. It's about emotions. Humans have emotions, right? Humans have emotions. So if you look at the stock trading practice, lots of especially stock trading practices by lots of retail investors, right? You see lots of emotions. In fact, a huge portion of the trades was actually driven by emotions, right? Fear of missing out, right? Panic selling, right? Lots of emotions are involved in the trading practice, and the machines don't have those emotions, right? Even for institutional investors, those big companies, so those investment banks, right? They are not actually driven by emotions like individual investors or retail investors, but it's any institution is still run by human beings. And Robert Shiller was saying that human judgment cannot be avoided in any kind of in all those investment decisions. In fact, those institutional investors sometimes are driven by those benchmarks, right? The benchmarks, those big funds has to meet those benchmarks pretty much every year or something, or exceeding those benchmarks, right? And so in some sense, emotions are just being treated in an indirect way inside of those institutions. That's not so obvious as among those retail investors, right? Um, so um, so 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 that's the first argument about the delayed reward and why I think artificial intelligence is better at handling those delayed rewards than human beings. And a second point that I was trying to make is about the size of the sample spaces, right? The sample spaces is actually huge, right? Which is true both for this Go game and also for the stock market. If you don't really understand what's actually sample space, I actually made a video um, in the same playlist, which is actually the first video that I made for this particular playlist, which is some of the basic statistical concepts that's kind of useful, right? I talked about a sample space, right? In fact, if the sample space is really, really big, this human experience, for example, if you take Go as an example, right? The Go game has been played in Asia for how many years? More than 2,000 years, actually. And it was played in the ancient times by intellectual elites. Very smart people play this game, right, for more than 2,000 years, right? But because this sample space is so big, even after 2,000 years of playing this game by human beings, humans were only able to explore a small portion, a very small portion of this sample space, right? And in this kind of case, artificial intelligence really has a distinctive advantage because it can explore a much bigger portion of the sample space than human beings during like 2,000 years, right? In a very short amount of time. In a very short amount of time, artificial intelligence will be able to actually explore the sample space to an extent that's unmatched by human experiences for the last 2,000 years, right? Because the speed of the calculation by those machines is actually much faster, right? So so uh, so if you actually sort of agree with me about those two similarities between the Go game and the stock market, it looks like if we can actually build a trading bot using reinforcement learning, just like Alphago trained for playing the Go game, there might be a chance for us to actually perform better than an ordinary human being in the stock market, right? So that's the end of this video. Thank you for watching.